Good evening, viewers. Welcome to the show. It's ImnShow again, and today we are having a special guest in the person of Ozurumba Afigbo. Ozurumba Afigbo is a business and financial analyst, and his area of expertise covers management consulting and training, SME development services, business strategy, and private equity investments. You're welcome to the show, sir.
Thank you. Thanks for having me.
Sir, please, before we continue, can you please tell us about yourself?
Okay, good. Like you mentioned, my name is Ozurumba Afigbo. My background academically is actually mechanical engineering.
Oh, interesting.
And then from that, after school, I got into finance. Essentially, initially working for an audit firm. Did that for about 5 years, and then moved on into banking at that time, corporate finance to be precise. From there into private equity, where we did a lot of SME work at that time. Subsequently, I've just done lots of business consulting and advisory work.
Interesting. This is not, this question is unplanned, but just out of curiosity, why the switch?
Okay, good question. At the time I left school, having gotten my bachelor's in mechanical engineering, of course, my dream, like the dream of every other engineer at that time, was to get into the oil industry and start making lots of money. Unfortunately, that year, there was a global slump in the oil industry. If I remember correctly, at that time, oil prices went as low as $15 to the barrel. If you consider that today we're looking at about $100 a barrel, you can understand how bad that was. So most of the oil industry players really weren't employing at that time. And so then someone mentioned the option of switching to finance, because in his view it was, a good way to get to the top fast. I don't know if that was correct, but anyway. So I bought the idea at that time, and then for someone who wasn't a finance major, I mean, if you didn't do business admin, you didn't do economics, you didn't. One of the fastest ways to get into finance was to join a firm, because at that time, and probably still today, the firms actually train you. They hire from across board. Once you meet the academic qualifications, they hire and train you basically, and then you do your ICANN exams, at that time. So I did all that.
So essentially, you evolved. What's the experience been? What do you think of the experience? That switch.
It was. Thinking back now, it was good. I don't regret it. Putting it that way. I don't regret it. And having that background in mechanical engineering, engineering as a whole, tends to broaden your horizon. And when you overlay on that other qualifications, in my case, becoming a chartered accountant, for some other people doing an MBA, for some other people even doing law or whatever, it gives you a deeper grasp of whatever you're doing.
Yes, sir. Absolutely.
Certainly, it gives you a very strong background in numerics. You're not scared of numbers. And so,
absolutely. And
that generally does help in terms of your analytical aptitude, your conceptual aptitude. It helps.
And it gives you a chance to actually fit in any sector.
Certainly.
Every sector deals with numbers.
Yeah.
Okay, so From looking at your profile, you are very experienced. You've worked with a lot of SMEs in Nigeria. So we want to know, we'd like to know, are there a set of or body of knowledge that an SME founder in Nigeria should have? And the part B to that question is, are there books you could recommend to these founders that could, better them?
Okay, I mean, that's a deep question, because business is very diverse, very broad.
Very dynamic.
So I wouldn't say that there's any specific body of knowledge, like some book, you read it and you're a good businessman. Sadly, it doesn't exist. I wish it did. But one thing is clear is that, you must never stop learning. So for someone who wants to become a business person ultimately, and then you're starting rather small, you must have a voracious appetite for knowledge. And because knowledge is infinite, you can never stop learning. And unfortunately, the hours in the day are finite, right?
Yes.
So you need to find a way to prioritize what you're learning. You can be learning forever. But if your ultimate goal is to own and run a business and be good at it, then you need to prioritize what you're learning. And in running a business, you can maybe classify the bodies of knowledge into two broad parts.
Okay.
On one hand, you have the core area that your business operates in. Right?
That is the sector, the market.
Absolutely. So, you want to bake bread. There's the bread industry.
Yes.
And then there's a deep body of knowledge there, right? You want to be, say you're a mechanical engineer, you want to support people's generators, fix their generators. Deep body of knowledge there, right? So for me, the first priority for a businessman or a prospective business entrepreneur is to understand the sector you want to play in. And you can do that by reading from the news, right? To trying to work in that sector if you can, because there's nothing like doing to help you learn, right? And then through interaction, you join the industry association. People in those industries will meet and they'll exchange knowledge and you learn. And so there's that. And if I had to put a score to it, I would put 90% there, right? Then there's the second broad segment, and that is, the underpinnings, what helps you actually run a business and it runs well, right? So that's finance, that's human capital management, that's supply chain management, ethics, and so on and so forth. So, and don't get me wrong, they're also very important, right?
Yes, sir.
But as an entrepreneur, your first business is to run your business, understand your business.
So for clarity's sake, are you saying that for the first important part of being an entrepreneur is understanding your craft?
Correct.
Right?
Correct. That's the starting point.
Okay.
Right? Not to say that the other parts are not important, but if you had to devote your time to gaining this knowledge, it would make sense to allocate a larger segment of your time to this core area, basically producing your service and selling it. Those two things, if you can do it, you have a business, right? The other aspect is almost like they say in Christianity, other things are added onto you, right?
Yeah.
So you can seek for those other things to be added onto you through, again, learning, interaction, reading, And of course, hiring experts, consultants can help you as well.
Yes.
But you need to understand what you want the consultant to do for you. That's why I say learning is also important in that segment.
Yes, sir.
Now, in terms of what can you read, there are tons of books. Again, the body of knowledge is limitless.
Can you mention 5 to us?
So if you wanted to, so let me describe broad classes, not necessarily titles.
Classes. Okay.
Yeah? So you want to read about the experiences of other entrepreneurs. So biographies of successful entrepreneurs, particularly people who had the same kind of trajectory you are looking to have. So, for instance, reading about how Google started up. These guys were students in the university dormitory, and they started working on something, and it took up. So, find books like that and read them. Right? It tells you, first of all, it prepares you for the sort of challenges you face as you begin your business. Challenges of finding money, challenges of business disappointments, challenges of environmental challenges. All those things are part of life. And when you see how other people were able to surmount those challenges, they help you. Then, of course, you have something that I think is very useful for a budding entrepreneur. I don't know, you've probably seen all these books, MBA in a box, 10-day MBA,
yes,
personal MBA.
Yes,
now, the good thing
personal
about
MBA.
Yeah. So the good thing about those books is that they give you a helicopter view of every segment of running a business. From human capital management to supply chain
They compress
management.
all this.
Absolutely. Make it in bite sizes. Because, generally the entrepreneur is a very busy person. It doesn't matter the size of his business. Even if he's just selling pure water, believe me, he's busy. His head is occupied 110% by the challenge of, how do I sell the next bag of pure water? So you find that he really doesn't have much time to digest Harvard Business Review. You need something that compresses the information and gives it to you in
a concise manner.
In chunks that you can manage. So that's what I would recommend. Spend as much time as possible understanding your business.
Okay.
All right? Understanding how to produce the service or the product, understanding how to sell it.
Okay.
And then add these other things that are good to have.
Okay.
Under the belt, yeah.
Okay. That is very apt. So you have it, viewers. In order to support us to keep giving you this kind of content, informative content that help you better your business, subscribe to our channel, like our videos, and keep following us so that you get regular updates. Now, coming to finance proper, there are a lot of times we hear as entrepreneurs, and sometimes we don't even know what they mean. And then sometimes, because we are a lot more shy, we don't want to come across as, not knowing enough. We just keep quiet, we don't ask questions. One of it is cash flow. In simple terms, what does it even mean?
Yeah, okay, so cash flow, you must have heard them say cash is king. Yeah? So that's cash flow.
Yes, sir.
Yeah? The cash that comes in to your business and how it goes out, that's your cash flow. And why is it critical? Because that's really what you trade with. That's what you can use to buy goods and services, and that's what you can distribute to investors at the end of the day as dividends, right?
Yes, sir.
But it's important to distinguish cash flow from profit. Because inherent in profit is money you haven't collected. In accounting, if I bought this bottle of water for 10 naira, and I can convince Mr. A to buy it for 15 naira, I've made a profit of 5 naira, right?
Yes, sir.
However, Mr. A may not have paid me yet.
That's correct.
All right? So, in that instance, the accountant will tell you you've made a profit of 5 naira. But in truth, in terms of cash flow,
You don't have
you
it
don't
yet.
have it yet. You see what I mean? So you find a lot of businesses who could be cash flow rich, they get a lot of cash flow, but they may not necessarily be profitable. And you have the flip side also, businesses that are extremely profitable, but they are cash poor. They don't and that's simply because, you know, either people tend to owe them, you know, they tend to sell on credit, so a lot of their money is outside. So they may have made a lot of profit, but they don't have much money in the bank.
So in the books, they are worth X amount, but then in the cash available to spend, to work with, it's not available.
It's not available. Yeah.
Okay.
So that's a simple definition, you know, a simple description or illustration
of cash flow. So cash flow is at every point in time cash available in a business to transact with, to work with.
Exactly.
Okay.
Exactly.
Okay, sir. Still on finance, in simple terms, can you talk to us about what a balance sheet is and why it's important?
Okay, good. And the balance sheet is one of the three main, if you like, statements, financial statements that a business should have at the end of each period. And the period can be a year, it can be a quarter, it just depends on the period you choose to look at. And so the first one is the balance sheet, like you mentioned. These days, they like to call it financial position statement, right? Same thing, balance sheet. Then you have your income statement, right? The old balance, profit and loss account. Same thing, income statement, profit and loss, same thing. And then you have your cash flow statement. Okay? So, zooming in on the balance sheet, what it is your, if you like, it's your statement of affairs at a certain point in time. So at the end of this year, let's take a year as the case in point. At the end of this year, what is your what? All right? In terms of the things you own, the things people owe you, the things you owe people, and the money that the shareholders brought at the beginning of the business. So
investments, assets, and then liabilities,
essentially.
Okay.
That's what your balance sheet is. It's a snapshot of where you stand as a business at that particular point in time. Let us say 31st December 2022, for example. Right?
So looking at your balance sheet and you understand the capital invested in that year.
Absolutely.
And you look at your liabilities, and then you look at your assets. You can tell what the business is worth.
In rough terms, yes.
In rough terms.
In historical terms. I say that because, you know, there are a few other things that go when you say what a business is worth. That is the business valuation now.
Yes, sir.
There are a few other things to consider if you want to be exhaustive.
Yes, sir.
Right? But yes, as a very simple check as to what is the value of this business. Yes, the net worth, which is in the balance sheet, tells you the historical value of the business.
Oh, okay, sir. We are coming to that part, business valuation. Okay. So the next question now is, why is it very important for an entrepreneur to have a strong understanding of finance?
Okay, yes. I mean, certainly you're right. It's important for every entrepreneur to have a strong understanding of finance. And the reason is simple. Finance is the language of business, right? If you went to Israel or Russia or Czechoslovakia, oh, well, it's Czech Republic now, not Czechoslovakia, right?
Yes, yes, sir.
And you pick up oil and gas businesses in each of these countries, all right? The single denominator you can use to compare them are their financials. So if you pick up a balance sheet of a company in Russia, pick up a balance sheet of a company in America, you know, it gives you a common denominator you can use to compare everything, because the language is
Finance.
finance. The treatment of transactions is the same. That there are standards globally that people align with. So when you pick them up, you can compare, right? That is the broad reason why you need to understand finance, because it is the language of business. But let's bring it home, right? So first off, if you ever need to raise money for your business, either bring in additional shareholders or borrow money from the bank, they're going to be talking finance, right? Let's even come closer to home. On a day-to-day basis, the businessman buys inputs, either goods or services, right? Adds value to them.
Yes, sir.
And sells them to his customers.
Yes, sir.
How do you determine how to price your products to make sure you make a profit? You need to understand finance to be able to price appropriately. Make sure you're bringing in all the variables to avoid a situation where you're underpricing your products or your services. So it's important. It's something
to avoid running a charity instead of a business.
Absolutely. You can, you know, if I take us back to what we talked about, cash flow and profit.
Yes, sir.
If you don't understand finance, right, you can be running your business and there's money in the bank all the time, and yet that business is dying because you're not making a profit, right? And the reverse is true as well. You can be running a business where it's tough to even pay salaries to, and you feel like, wow, this is a terrible business. But the truth is, you may have a very profitable business on your hands. All you're having is cash flow challenges that a working capital facility from the bank will sort out for you. You know, so it's important to understand these things and be able to make.
So you can have a
decisions.
fine business, if I get you correctly, and you're even struggling to pay staff, deal with, you know, your financial needs.
Absolutely.
And so that's a knowledge gap, if I'm correct.
No, it's not necessarily. Some businesses are like that by nature. Let me give you some examples. You know anyone who runs a nightclub?
Yes, I know a few persons, but I don't understand the inner workings.
The inner workings. Okay, good. So let me tell you how nightclubs function. You know, the high-end nightclubs. Now, because of the fact that they tend to put a lot of premium on the big spenders, you know, the stars, you know, the movie stars, the musicians, the show business people. They like those guys to come to their club because it pulls the crowd, right?
Yes, sir. Yes, sir.
Now, but those guys don't always have cash to pay. Sometimes they actually don't have liquidity to pay for, and they come in and they buy drinks of, you know, some of those drinks are $500,000 a bottle, right? They run up huge bills. That's the nature of the business. If you insisted that all of them should pay money, they won't come to your club, and by, you know, implication, the crowd won't come, right? So the nature of that business is that people tend to owe you a lot of money. But the truth is that that bottle of drink you sell for $500,000 probably cost you 60,000 naira.
That's a lot of profit.
So that's huge profit they make. but they may not have cash.
So technically all you need to do is get enough money to keep the business going.
Absolutely. And your money, and be very good at getting your money in. So yes, they can owe you, but you have to be very rigorous about following up and making sure that they pay. And know when to say, oh guy, you're owing us too much. Pay the one you're owing.
Yes, sir.
Yeah.
Yes,
So.
sir. Thank you, sir. This is informative, actually.
And I can give you an example of the opposite.
Okay.
If you run a transport business, right? And transport can be Okada, it can be motor vehicle, it can even be an airline. The same problem. You bring in a lot of cash every day. So on a day-to-day basis, it can look as if, wow, this business is profitable, we're maxing out, But then, once you realize that for every money you make, you need to set aside money for maintenance. Because one single
breakdown
can take half of the money you made the last how many months. So if you were spending that money on a day-to-day, one day you could be out of business. Same thing with hotels. They get a lot of money on a day-to-day, but every 6 to 9 months they have to take out the curtains, change the bed sheets, remove doors that are shaking, fix the ACs. And so you find that money you thought you made really doesn't belong to you. It belongs to the repairers. It belongs to, So that's what I'm saying, that if you don't have a sound finance background, if you don't have a good understanding, and I'm not saying everybody should go and become a chartered accountant, right? But if you don't have a good basic understanding of how these things add up, you will make wrong decisions based on either how much money is coming in or how much money is not coming in, and then.
Okay, sir. So this is really, really, really informative. Our next question is, we hear when you go to a financial institution, microfinance bank to take up business loan, we hear them trying to calculate your credit score to determine how much they can offer you.
Yeah.
How do they calculate this credit score?
Yeah, okay. So that frankly would vary from institution to institution. Each institution has their approaches to calculating the specifics of, and that's probably what makes the difference between a good lender and a bad lender. But in broad terms, there are a number of pillars they look at. All right. In the industry, they are sometimes called the canons of credit.
Canons of credit.
Yeah.
Okay, sir.
And depending on how you want to look at it, there are 4 canons. Some people have 5, look at it as 5 canons. And those canons are simple. So the first, and in no particular order. So the first is capital, right? Generally, the lender doesn't want to finance you 100%.
Okay.
All right. So if you show up, you want to set up a water bottling facility, the lender wants to meet you halfway. He wants to believe you've done some things already by yourself. You're not coming empty-handed. So you need to have sufficient capital for the lender to even want to lend to you. So sometimes you go to the bank, they say, okay, we like this business, but you need to bring 40% of the capital required, and we will give you 60%. So that's to force you to put down some capital to reduce their own exposure. So that's capital, the first one. The second one, character. However good the business is, if the gentleman in question or the lady doesn't have character.
What does this character mean?
Character basically means, can I trust this guy? What's his background? What's his history? Which is why, for instance, in Nigeria today, we have the credit bureaus. All right? And what they do is they keep a credit score for everybody based on how much money you've taken from banks and how much money you are owing. So if you are owing banks all about the whole place, you have a very low credit score. And all the banks have to do is to put in your name and they'll see your credit score. And this guy took facility from, Lagbaja Microfinance 10 years ago and he hasn't paid. Of course, they won't give you their money. So that's character, all right? So we've said capital, we've said character.
Character.
Collateral, right? At the end of the day, yes, it's a good business. All things being equal, you should work and pay back our money. But what if something goes wrong? This money the banks are giving you, it's not their money.
It's other people's money.
It's your money and my money, right? So they want some assurance that if I give this guy this money and things go south, I'm not left totally exposed. So they want some collateral. And collateral can be a house, can be landed property, it can be shares in a good company, and then basically they want it to be some coverage of the money you are borrowing. If you are borrowing 100 naira, they probably want collateral of 120 naira. So we said capital, we said
character,
we said collateral.
collateral.
Number 4 is capacity. And this is beginning to sound like P2B now. We're talking about capacity and character and what have you. Yeah. But yeah, so capacity. What is the capacity of this business you are planning to pay? Right? If you, and that's where they want to look at the business. Okay, you want to bottle pure water. You want to bottle table water. What is the demand for table water? Can this thing generate the cash flow to pay for this money?
How viable the business is?
Absolutely. Can this thing pay for this money you want to borrow? Right? They feel like it can't pay, and they won't give you the money.
Okay.
And then the 5th one is condition. So that's what's the environment like? Something that could be a good business today may not be a good business tomorrow, based on maybe government policies. I mean, if you were a POS operator, if by the time we're all going cashless, I don't know, what would they be doing? So the conditions of the environment also drive credit decisions. So those are the main things they look at in deciding is this a good business to fund or not. And
what's score?
Absolutely, and so what level of risk waiting to put on it. So for instance, that's why as expensive as bank loans are in Nigeria, I'm sure Nestle, for example, will not pay the same interest rate as Afigbo and Sons. You understand? Because when you lend to Afigbo and Sons, you are taking a bigger risk. All right? So all those considerations go into even the pricing of the loan. So what kind of interest rate should we charge this guy? Yeah, all those things count.
That's interesting. Thank you, sir. So the next question now is, as a business person, SME, what are the factors you should consider before approaching these financial institutions for lending?
Yeah, I mean, so ideally, you should be asking yourself these same questions I talked about. These 5 things. You should really be weighing yourself against those things and saying, do I measure? But at the end of the day, the key thing you need to ask yourself before you go borrowing money is this initiative I want to fund, can it pay for this loan I'm taking? If you can't pay for the loan, the best thing you can do for yourself is to stay away from any kind of borrowing. If you're not sure, because don't forget, you own the business. Ideally, you should understand your business, which is why I say that's 90% of the
Without
game.
being too optimistic.
Yeah. You need to be able to tell yourself the truth. Is this thing going to fly? Because I've seen businesses who are doing okay until they took a bank loan. And they went down from there. Not because bank loans are bad, but because they took the wrong bank loan. They funded the wrong project. The time frame of the loan was wrong. The worst thing you can do for yourself is to take a 30-day loan and use it to build a house. So you need to look at all those things, put them into context before you decide if you want to borrow money or not.
Okay. We'd like to go on a short break, and we'll be back after this short break. Welcome back, viewers. We are still on the show with Mr. Ozurumba Afigbo. Thank you for being here with us, sir.
Pleasure is mine.
Yes, sir. Now, we've talked about factors to consider before you approach a microfinance institution for lending. Now, this question is a critical question for us here. For an entrepreneur, how much debt is too much debt?
Okay. So again, that's one where there's no straight answer because it varies by business. So if we go back again to the examples we looked at, one which is a very cash liquid business, a lot of money coming through. One which is profitable but not very liquid. Right? So you find that depending on how your business cycles are, you may be able to take on more debt, take on more loan than ordinarily, other businesses can get away with.
That is, if you are turning over.
Yes, if your business turns over quickly and you are liquid, cash is actually coming in. So then you can take on a bit more debt, and you are able to turn over fast enough and pay down, and so you're fine. For businesses who have a slower business cycle, then you need to keep your loan burden down. I don't want to go into, there are actually calculations you do to determine, the equity of the ratio of equity to loan and so on.
I've actually seen somewhere that for the 5% is too much loan, is too much debt. How true is that?
No, that's not true. Again, it depends on your business. Depends on your business. And let's look at examples. For instance, if you are a trader,
Yeah.
if you're a trader and your business cycle is 10 days, right?
Yes, sir.
Now, when you borrow money from the bank, really, the interest rate they quote to you is for 360 days, right? So you take a loan of 5 million naira, and that loan is at, let us say, 25%. What they are saying is that if you take this 5 million naira and hold it for the whole year, when you're returning that 5 million naira to us, you need to return on top of it 25% of 5 million naira. That's essentially what they're saying to you. Now, but this guy whose business turns around every 10 days can take that 5 million naira loan, and he trades with it. And let us imagine that his profit margin was even 10%. So every 10 days, he makes 500,000 naira on that 5 million. Every 10 days. In a month, he would have made
25%.
Yeah, no, he would have made 3 times that. He'd have made
Yes.
3 times 500,000. And he's made 1.5 million on the 5 million, which probably pay his interest for the whole year. So that kind of person can comfortably take on more debt than this 45% you're talking about. Because
So
the more debt
for this example, in perspective, what will you cap it? What percentage will you cap it?
What would be the so essentially the biggest if you like risk he will be looking at is if something goes wrong. I mean, because this calculation we did now is all things being equal, right?
Yes, sir. Yes, sir.
If the customs,
the profit being profit.
Exactly. Well, not even profit being profit. That no extraneous factors come into play. If the vehicle, let's imagine that this business he does is that he brings oranges from Benin and sells them in Lagos, right? If the truck carrying his oranges collapses or overturns at Ore, what happens? What does it tell the bank? So over and above the business, so it may make sense from a business perspective to take on as much debt as possible because but you need to, at the end of the day, ask yourself, this money, I have to return it whether or not I make a profit. And so at some point, you need to cap it based on what you can survive if something goes wrong. You see what I mean?
Yes, sir.
So you know that, okay, if they wake me up in the night, say return my money now, I can return 10 million. So you cap it at 10 million. You know that, and that's as your capacity grows, then you can take on more. When you get to a point where there are people in this country who, if you annoy them, they can write a check of 1 billion naira. So if that's your capacity, then that's your, But that's the simple way to look at it.
Okay.
Yeah.
Okay, sir. Okay, so we hear the term recession. And then some of us, we don't even understand what this thing means. And for business people, entrepreneurs, from a business perspective, what is a recession? Yeah. And what are the signs that indicate recession that you can just see and say, oh, there's a recession? Yeah.
Okay. Actually, a recession is actually an economic term. It's a very specific description of a situation in the economy where you have, I think it's 2 consecutive quarters of negative growth. That means your GDP is reducing
consecutively.
Yeah, for 2 quarters consecutive. So quarter 1 negative, quarter 2 negative. You're in a recession, right? Now, but what's the impact for you and I? The GDP is simply an exotic name for how much business is the population doing among themselves.
For the country.
For the whole country.
Yeah.
That's really what GDP is. And if you have a situation where the volume of business is reducing, not that it is growing slowly, no, it's actually
depreciating.
It's actually reducing.
Yes.
For 2 quarters, what it means is that people have less money to spend, right? And if people have less money to spend, then it has so much impact on how much the average business will be able to sell. That's one. Two, it has impact on even the kind of business they want to patronize. Right? So, whereas if you were selling Gary, right?
Yes, sir.
The impact of a recession on the Gary seller might not be the same as the impact on that high-end nightclub we were talking about a few, right? Because, you know, luxury, you know, that's more of a luxury.
Luxury businesses.
Yes, luxury
suffer
businesses
more.
will suffer more. Because those are the first things people will trim off. You eat first now before
yes.
you go drinking.
Yes, sir.
So it's important to bear in mind, depending on the business you're running, to know if we're in a recession or not, because that should then help you make certain decisions. Should you be, for instance, borrowing money at that point? Certainly not. Should you be hiring additional staff at that point? Probably not. So you need, when you are able to track and watch the economic developments, it also guides you in terms of the business decisions you take as an entrepreneur.
Okay, so I think you're already even flowing into the second question I have in mind. And that question will be, in recession, what are the decisions that SMEs, you know, founders can make that can help protect them, you know, for profitability and sustainability of the business?
Yes, so good question. Is to cut down your cost. As a simple, reduce your cost profile. So that may mean, sadly, letting go of staff. It may mean reducing your outlets. If you're a branch business and you have this new branch in Aja, you just set up and it's struggling and you have to support it. In a recession, you may just have to decide to let that branch go. You know, and consolidate on the branches that are established and standing on their feet. Different decisions. You may call in your vendors and have a very hard conversation with them about their pricing. You know, during one of the recessions, I was doing a bit of work for an organization that is an oil service firm doing work for, you know, some of the major companies. You know, when I say major companies, you know who they are, right? And those companies basically summoned all their vendors and said, look, you know, we don't want to hear anything. Go and come back with a discount for us. Everybody. And then when you come back with a discount, they say, no, we won't accept any discount less than 20%. They don't want to know how you are coping, you know. So in a recession, sometimes you have to do that because you must bring your costs down and so on.
To the barest minimum.
To the barest minimum. Of course, costs will include, you know, interest costs. So if you're not absolutely sure about what you're borrowing to do, you probably don't want to borrow in a recession. But of course, if you know, all of these, they are not hard and fast rules. It could well be that in the recession, because other businesses are struggling, there's an opportunity to buy a competitor at a low price, you know, and you're able to borrow money and do that. That might be a good decision.
That's like the likes of Warren Buffett.
Yeah, well, you know.
Buy while others are selling.
Exactly, exactly. You know, see, he says when people are greedy, he gets scared.
Yes.
And when people are scared, he gets greedy.
Yes.
You know? So if you're in a position where you can do that, yes, it might be a good idea.
Oh, okay. Thank you, sir. So, my next question is, in simple terms, what are liabilities, assets, equity?
Okay, good. So, yeah, again, those, if you remember, those are actually the components of the balance sheet we talked about earlier, right? So, essentially, your assets are those things that belong to you that you can use to generate income. All right? And when I say generate income, I'm not describing that narrowly as in, people giving you money. Sometimes it also saves you money, So it belongs to you and is providing to you services you would have paid money for.
Does that include intellectual property?
Yes, absolutely.
Okay.
So, then you have tangible assets and intangible assets. So tangible assets being chairs and tables, motor vehicles, machines. Intangible assets being, licenses, intellectual property, patents. Those are things you can't touch, but sometimes they're even more valuable than the tangible assets. So those are assets. Then you have liabilities. Essentially, liabilities are, exposure to the business, obligations you have to third parties. All right, so those could be to the bank, if you borrowed money from them. Could be to your suppliers, if you haven't paid the guy who gave you diesel. Right? It could be to government. You haven't paid your taxes. So all of those are liabilities. Yeah. Then finally, you have equity. Equity essentially refers to money that belongs to the shareholders. It could be money they brought in originally as startup capital. It could be profits that you've made over the years that you haven't paid as dividend. They are still inside the business. It's all part of equity. So those are.
Okay. Now we are coming to a question that's critical. In Nigeria, a lot of businesses, especially small businesses, medium enterprises, they run away from taxation. They're not always tax compliant. So I want to ask, what is the importance of being tax compliant?
Yeah. Okay, good. Maybe one can step back and even ask, what's the value of tax? Why is tax? Why bother? Why?
Yes. Yes.
So the truth is, at the end of the day, a tax is like, I like to think about it like a social club, right?
Okay.
When we join a social club, we join because of certain values.
Yes.
We are going to get from that club.
Benefits.
Isn't it?
Yes.
Benefits.
Yes, sir.
Good. For that club to exist and continue to render those benefits to us, we must sustain that club, isn't it? So
That's
from
correct,
time to time, we pay something dues to the club, right?
Yes, sir.
Good. That's what your tax is. Your taxes are the dues you pay to government for them to continue to provide security, continue to provide the shared services that nobody will want to do with his own money, right? So that's really what taxes are. And if you go to the bottom of it, the reason why Nigeria is the way it is, at the end of the day, is because we don't pay enough taxes. That's the truth. Now, there may be an argument of, okay, the ones we paid, what did they do with it,
It's
right?
appropriations.
So that's a fair argument to make.
Yeah.
That's a fair argument to make. But bear in mind, at the end of the day, this country doesn't belong to those guys in Abuja. It belongs to you. So if you don't pay taxes, at some point, it will be the way it is now. And that's where we are. All right? So that's the larger of why you should pay taxes. But for a business, from the selfish perspective of a business, which is in existence to maximize profit, right? It's simply to protect yourself from the unpredictability of owing taxes, right? If you pay your taxes, you reduce the chances of unexpected charges. Because, the government has the right to come back in, I think, 7 years' time, 8 years' time, and collect their taxes. And in fact, if they prove that you used, you evaded the tax completely, you dodged tax paying.
Tax evasion.
Yeah, they can come back in 100 years and collect their tax. So the point is that as a business that has shareholders, what you don't want is a situation where you have to basically cough out money you have already enjoyed. So to avoid that, as much as possible, you try and foresee what your tax exposure is and make provision for it and arrange to pay it in a way that you are in control of, right? Not necessarily a situation where you've made your plans for the year, done your budget, and government comes knocking, and suddenly you find that half of the money you thought you have actually is not there anymore because you have to pay to government. So a good business generally, beyond the duty as a corporate citizen to make sure you pay your social dues to government, as it were, you also know that to stay in control of your business and be able to predict your returns, your condition, your status, your statement of affairs and all that, your state of affairs rather, sorry. It's best to be in control of your tax liabilities.
Okay, thank you, sir. Now, our next question is, we hear business people, it's important to plan your financial year, your fiscal year. How can a realistic budget be planned? And with a rough sketch, what does it look like?
Yeah. Okay, so basically, how would you do a budget? So essentially, it starts out with what are your goals for this new period. Let's imagine that we're talking about a budget for 2024, for example. So what are your aspirations for that period as a business, right? Now, when you know where you want to get to, then you are able to then estimate what resources you need to get there. How much business do you need to do to get there? So let's try and use examples. Let us say that in your industry you are currently ranked number 6, right? In terms of, if you like, the league table.
Yes.
Now, and you're saying, look, by 2024, I want to be in the top 4. That has implications because it means that you need to do more business than the guys from number 5 down, right? So you give yourself a target in terms of that, how much business you need to do. That has implications. For you to do that much business, you need to buy material, right? For example. So essentially, based on that, you are then able to build a budget. And the budget just looks like your financial statement. Exactly. It's just that it is forward-looking. Whereas your income statement for 2022 shows you how much you sold, what expenses you incurred, how much profit you made for 2022. Your budget for 2024, exactly the same lines.
Income expense.
But income expense, but you're looking forward. Now you're saying, come 2024, how much do I need to have sold? How much do I need to expend to make this kind of sales? So based on that, what kind of profit am I expecting? Now, when you've done that, it now becomes like a tool for you to measure yourself, to check yourself. From time to time, you look at that performance you planned, check where you are, and then you know whether to, increase speed, reduce costs, do more business, drive your salespeople harder, depending on what you need to do. It also helps you to, when you've done all that, okay, I want to sell this amount next year, I want to I'm going to have to incur this kind of cost, this kind of profit. You need to then ask yourself, what tools do I need to achieve this? Right? Because if, for instance, you are in the distribution business and you have only 2 trucks, it would be wishful thinking to just sit down and put big numbers. Yeah? You need to say, okay, so how many trucks do I need to do this? Maybe you need 2 more trucks or 3. You know, so all that is budgeting, and those are questions we need to ask ourselves at the beginning of each period.
Okay, thank you, sir. So the next question now is, in business, we keep hearing, especially when you want to start up as an entrepreneur, you hear people say, oh, go and develop a business plan. You know, what is your business model? The question is, what is the difference between a business plan and a business model? And why are they important?
Okay, good. So essentially, one is a subset of the other, right?
Yes, sir.
So the business plan is, if you like, the umbrella master plan for the business.
Yes, sir.
That says, this is how you want to do business going forward. This is where you want to be by X period. And this is how you are going to do it. And then these are the financials that will come out of it, right? The business model is a subset of that. The business model essentially is saying, how are you going to do business? That's really what the business model is. You know, how are you going to get your customers? How are you going to get products to your customers? You know, how are you going to manage your staff? Are you, for instance, going to have staff on your payroll? Or do you bring them in on a job-by-job basis? All that is business modeling. So it is those decisions about how you are going to run your business that is your business model, right? But clearly, in your business plan, a component has to talk about your business model. So your business model, a good business plan should include the business model for that business.
At any point, are there the business model, at any point, does it become more important than the business plan?
I wouldn't go that far. But yes, there are certainly instances where what the person wants to hear about is your business model. And not for you to go and...
Especially in a competitive market.
Exactly. So there are times when the first thing really is, what's your business model? Because your business can rise or fall based on how good or bad that model is, right? But at the end of the day, your business plan is a communication tool, right? So at the end of the day, it's a number of pages of paper with a nice, with a nice binding, yeah?
Yes, sir.
That's your business plan that contains all of this information, key to which is your business model. Your business model is...
So, do we want to say, would you agree if I say the business model is the unique way you want to go about doing your own business?
Precisely.
Okay.
Precisely how your business strategy holds together, how you want to go about your business. That's your business model.
Okay, sir.
And you can have a wonderful business model and it's not written down. By the way, that is not good either, because you do need to have documented, right?
Yes, sir.
So for so many reasons.
For so many reasons, especially for a guide.
Guide your staff, guide third parties. Whenever you want to talk to a banker, you want to see that, So there are so many reasons why you need to actually have it documented and kept somewhere. But certainly, if you like, that intangible, which is the business model, which is hopefully understood by everybody in the business, right? That is how we do our stuff. Very, very critical.
Thank you, sir. Now, the next question now is, for young entrepreneurs, greenhorns, what is the best way to go about capital financing?
Okay, I mean, the truth is, you know, like I've probably said this so many times, there's no one way that fits all, right?
Yes, sir.
But so for instance, if it is your startup capital, the truth of the matter is that the first money you put into a business, most of the time is your own. And when I say money, I don't necessarily mean cash. It could be your time, your sweat, right? It is that provides the first foundation on which third parties can then give you money, right? So you find that the first money that goes into a business starts at the beginning more often. Of course, if you are lucky and you have a rich uncle, it helps, but 99% of us don't have that. So you need to put it together yourself, put in your time, put in your sweat. So that's startup funding. So once you have shown some traction, your bank manager can see some movement in your bank account, can see some pattern. When you sit down with him and say, you know, this is the challenge I'm having, right? He's more excited.
Yes, and receptive.
He's more receptive because it seems to make sense. He can see he's watched you over some time. He's now able to say, okay, you know what, let's start you out with 500,000, you know, and see how it goes. And then you do well, and then that goes to 1 million, and so on and so forth, right? So that's at that stage. Then you have the other capital financing where maybe the business is fairly stable. You need more assets now. You need more motor vehicles. You need an additional factory line. You need, you know,
Expansion,
right? So at that stage, again, the options are different. You could talk about bank funding. You could talk about you know, equity financing. That's where people then talk about things like private placements and so on and so forth. So those are all options, but it depends on your stage and how the business is doing.
Okay. This will be our last question, sir. And this question is for consultation purposes. How can people reach you, sir?
Yeah. Okay. So, I mean, this is my office. It's a shared facility called Enterprise Hubs, you know, so even if I'm not here, they'll take messages. They know how to reach me. In addition to that, I have my LinkedIn page, which you know,
which you'll find. You'll definitely find on the screen. You're probably looking at it on the screen right now. And the email address.
Yeah. So the email address is o.afigbo, my surname, at Synergia, which is my organization's name, .com.ng.
Oh, okay. Afigbo, spelled as
that's O.Afigbo, spelled AFIGBO.
Yeah.
At Synergia. Synergia is Spanish for synergy, spelled SINERGIA.
Okay.
Okay.
.com.ng.
Yeah,
Okay.
So that's my email.
Okay. So viewers, we'll have Mr. Ozurumba again to discuss, to go deeper into finance, into business finance. We want you to stay tuned so that we want you to also subscribe to our channel. Click the bell icon which you are seeing right now so that you can get notifications for updates like this. Thank you very much, sir. The session has been very informative, educative, and well insightful.